Good day. My name is Professor Anthony Riccio. I am the founder of the Financial Advisors Group, a money management firm since 1996, and CEO of Riccio Online Financial Advisors since 2021. I am also a college professor of personal finance, both at Monroe College and Herbert H. Lehman College in the city of New York. Welcome to our video cast. We are going to be talking about income tax planning for, for retirement. So please grab a pen and a piece of paper, because I am going to attempt, I hope, to take what could be a 4-hour lecture and turn it into 10 minutes. So of course I'll be brief, but I also will be specific. Sit back, grab a pen. Here we go. And I have notes as well, so I'll be referring to them every now and then. Let's talk about income tax planning for retirement. What is the goal when we talk about income tax planning for retirement? No, ladies and gentlemen, it's not where are the income tax deductions for retirement. No. The goal is to make sure that you minimize your tax burden, not just this year, not just next year, but for your life. Right, for your life of retirement. And we do that by managing your savings and investment plans, right? So that's the goal that we're talking about here. So I'm going to hit you, ladies and gentlemen, with a 4-part strategy plan. And it's going to be from your accumulation years in your 20s all the way to your beginning of your retirement years in the 1960s. So when we talk about strategy number 1, your accumulation phase, right? We're talking about your 20s, maybe 30s. Well, what type of accounts do I use, right, for retirement? Understand, ladies and gentlemen, and please write this down, there are only 3 types of accounts that you can use. You can use tax-deferred accounts, you could use tax-free accounts, you could use tax-advantage accounts, you could also use savings accounts. You could also use investment accounts. But understand, with each account you use, you, of course, generate interest. Well, is that interest tax-deferred? Is it tax-free? Or is it declared as ordinary income where it's taxable? Well, tax-deferred accounts, like IRA plans, like maybe your 401k plan at work or your retirement plan at work, those are called tax-deferred accounts, so you're not paying taxes on that every year, as I'm sure you know. Tax-free accounts are accounts such as a Roth IRA plan, municipal bonds, things of that nature, and those are, of course, tax-free. Dividend accounts, such as investment accounts, you might have at Charles Schwab or E-Trade or maybe at your local financial institution. Savings accounts, like with your local bank, right? Those are taxable. And they're taxable every year at the tax rate that you're in. So, of course, as you're young in the 20s and 30s, you'll, of course, accumulate money in those accounts. But understand, the interest in those is taxable. So, how do I manage that? Well, you manage that, ladies and gentlemen, by speaking with a financial advisor so you can understand the answer to one simple question. How long will the totality of my savings last? Right? So you figure that out with a financial advisor, not an income tax advisor, because again, an income tax advisor, you'll be looking more for retirement-based deductions in the income tax code. And yes, there are some, and you should be aware of them. This conversation is tax planning. So again, strategy number 1, you want to understand what these accounts in the world can do for you when it comes for retirement. Tax-deferred accounts, tax-free accounts, and then you have taxable accounts, right? Like savings accounts, investment accounts, that you have to pay taxes on that. So you want to save, of course, but you want to save the right amount in the correct accounts to minimize your tax burden. So you want to do that in your 20s, 30s, 40s, and during that time, ladies and gentlemen, if you decide that you're putting money in your retirement plan at work, for example, right? Remember I said now that's a tax-deferred account, right? Well, when you get into your 50s, I strongly recommend, ladies and gentlemen, that you decide to take that tax-deferred account and then transfer it to a tax-free account, because you can. If you're in your 50s, you can do that right now. You can say, okay, I've accumulated this money, tax-deferred, and I want to put it into a tax-free account. A little bit of good news, a little bit of bad news. Bad news first. As you decide to make that change, at that point, yes, you're going to have to pay your taxes on that accumulation phase. And you can do that right away. Because now you're in your 50s, and hopefully you'll be living to 70, 80, 90, right? And all that money in that account now grows tax-free. So, of course, many people call me and they ask me, Anthony, which one is better? Should I leave it there? Should I transfer it? It is on a case-by-case basis, so there is no one-size-fits-all answer. However, in my 35 years as a financial advisor, I find in your 50s, that's a very important situation to look at. So again, strategy number 2, when you get to your 50s, if you have money in tax-deferred accounts, you might want to consider the possibility of transferring it to a tax-free account. Which now brings us to you coming into your 60s. So now you're 60, 61, 62, I'm 65. You might be getting those Medicare notices, right? Oh my God, let me not even go there, right? Social Security, that's also another problem, right? But what it means is that now you're getting ready to settle retirement. 2 strategies comes to that. Strategy number 3, withdrawal strategy. Right? Remember I was talking about the accumulation strategy? Now strategy number 3, withdraw. How do I withdraw correctly? Again, with the goal to minimize my tax burden. Ladies and gentlemen, when you're in your 60s and you want to take money out, the first account you should take the money out of is your taxable account, your savings account, your investment accounts. And then you want to follow that up by looking at your tax-deferred accounts second, right? So once you make a plan to exhaust your taxable accounts, then your tax-deferred should be second. So, of course, your tax-free should be last. And in doing it in that layer, again, the goal being to minimize your tax burden for life, that would be the appropriate way to do it. And the final strategy, now going into your 70s, right? Well, now you got a final decision to make. You're going to hear something called RMD. What is that? No, it's not medicine. I wish it was. It's called Required Minimum Distribution. And in your 70s, of course, what that means, in layman's terms, is that now you have to start taking money out of the account. You have to. There are ways of shifting it back in, but that's another conversation. But by law, you have to start taking it out. So you want to, again, sit down with both a financial advisor as well as an income tax advisor, because if you're taking money out of a tax-deferred account, right, well, that's going to be declared as ordinary income when you take it out. So, of course, you want to be sure it doesn't put you in a higher tax bracket. The theory being that as you're accumulating money, you're in a higher tax bracket. When you retire, in theory, you should be in a lower tax bracket. My clients, I find that's the case 80% of the time. The other 20% of the time, they do very well during their accumulation years. They're not just sources of earned income, but unearned income, right? A lot of people forget about unearned income being a part of income. So, ladies and gentlemen, I hope I educated you with this 10-minute video. I don't know if I went over 10, under 10. I just felt the information was important for you to know. So again, when we talk about income tax planning for retirement, your goal there should be to minimize your tax burden for life. And again, you want to understand the type of accounts that are available in your 20s, 30s, and 40s. Plan appropriately. In your 50s, you might want to look at what we call a Roth conversion. And then in the 60s, you want to put together your withdrawal strategies. And then in the 1970s, you want to look at RMD situations, how to withdraw, when to withdraw. And then when you're in your 80s, ladies and gentlemen, hopefully I'll meet you there. If you need any help, feel free to give me a call. 347 575-5045. Have a good day.